The stock market is reaching valuation levels that are causing concern. Federal Reserve Governor Lisa Cook recently warned of elevated valuations that suggest markets may be priced to perfection and therefore susceptible to large declines. Some market watchers compared that speech to former Fed Chief Alan Greenspan's warning of irrational exuberance during the dot-com boom. And coincidentally, the market just reached the same valuation it had when Greenspan made that warning back in 1996. And all of that is about to come to a head in the coming weeks with corporate earnings. As holiday financial reports are released, companies must hit their marks, or we could see those large declines that Cook warned about. When I say valuations are high, I'm not just talking about the trillion-dollar market capitalizations of the largest companies. A very common way to judge valuations of individual stocks or the stock market writ large is through comparing it to corporate earnings. This is called a price-to-earnings ratio, or PE ratio, and it shows how much investors are valuing each dollar of corporate earnings. A high PE ratio can mean a lot of things, including that the price is too high or that earnings expectations may be too low. This chart shows the forward price-to-earnings ratio of the entire S&P 500. As we can see, from 2000 to 2025, the average forward PE was around 16.71. The highest peak we hit was 26.37 in 2000, just before the dot-com bust, and the lowest PE ratio we saw was 8.94 in 2008 when the Great Recession struck. The PE ratio as of early January 2025 is 21.86, well higher than the historical average. That suggests investors are bullish and willing to pay more for future earnings. Notice that I called this PE ratio we've been discussing a forward PE ratio. That means it's using earnings expectations for the next 12 months. And those expectations are intense. Even while operating at historically high profit margins, the S&P 500 is expected to grow earnings by a double-digit percentage in the fourth quarter of 2024, as well as for the entire calendar year of 2025. As you can see on this chart, Wall Street expects the best holiday earnings growth since 2021. Now, companies that track holiday spending, like Adobe, have said that sales were strong in the holiday season, but profitability will depend on other factors, such as how big discounts were offered and how many temporary workers were hired. And if you think expectations for holiday earnings growth are high, brace yourself because expectations for this year are bigger. Wall Street again expects the highest earnings growth since 2021, when pandemic profit issues made gains look bigger than they actually would have been. So when you look at these charts of high expectations for earnings and high valuations, even when baking in those earnings expectations, you can see why Cook is so worried about a market that is priced to perfection. So as all of these companies report holiday earnings and deliver forecasts for 2025 over the next few weeks, they will have to be perfect as well. So what does a perfect earnings report look like? Well, basically, these companies are going to have to live up to Wall Street's expectations for the holiday season and then predict they will do it again in 2025. Anything less than that, and we could see a major adjustment.